Was it you guys at Pimco that caused this spread blowout in corporates in China?
Oh, so not guilty. So no, there's nothing there. And then more generally, I mean, you've seen with global credit markets, you have seen some volatility the last couple of weeks, some name-specific volatility that's spilled over into the high-yield indices. It's been a year of strong performance, and we're getting later in the year, so some profit-taking there. In terms of our credit posture, we're still reasonably constructive, but we've gradually been paring back our global credit exposure, going a bit more liquid throughout this year.
Okay, so you think it's really just a little bit of posturing, maybe month-end flows? You don't think it's anything more serious in China? What about the news over the weekend? We were anticipating it was actually better than forecast, that South Africa was downgraded once again. Now it's out of the Bloomberg Barclays Global Index now, but it's still in the City Index. What to do about frontier markets?
So I think it's very small in the index, so that's important. I was looking at this with some of my emerging market colleagues today. It's quite small in the index, so I don't think that should be a big driver over time. Clearly, Moody's has them on watch, so that's something that will be important over time. It's a difficult outlook. There's a lot of political uncertainty. I mean, that's what happens with emerging markets. Overall, we're pretty neutral in terms of the credit.
A lot's being said about the synchronized growth we're seeing globally, Andrew. You've got the ABCs of caution. Are we too optimistic by talking about this wonderful synchronized recovery we're seeing across the globe? Is there an element of complacency there or not?
So I think on the growth side, it does look good. Our point is this may be as good as it gets in terms of the cycle. We have central banks tightening as the expansion gets older. The risks, grow every year. In the US now, this is quite an old expansion. We're fixed income people, but we don't want to be too pessimistic. Overall, I think the backdrop is pretty good. But when you have valuations in credit space like those we have today, volatility at such low levels, the US, Europe, and beyond central banks tightening, we think it makes sense to be a little bit more cautious. The easy period is behind us when you saw the ability to be exposed to the beta and ride the spread compression that we've seen. We think in the next stage of the cycle, you've got to be a lot more careful as the credit cycle turns over time. That's when you earn your corn as an active manager.